Well, good afternoon, everyone. I think it's about that time, and so we can probably get underway here. I just want to take a brief moment to welcome you all to today's webinar, which is a presentation on the 2022 property tax outlook for New Brunswick. My name is Mark Turner. I will be acting in the stress-free and laid-back role of webinar moderator today. I'd like to introduce you to Andre Pouliot, Senior Manager of our Tax Division, as well as Chris Jobe, Divisional Manager. Andre is going to be taking the lead as the presenter of today's webinar. If you have any questions or comments that you'd like to make during the presentation or at the end, please feel free to submit those via the chat option. If it's a question that appears to be relevant to a specific slide that we're on, I'll reactivate my camera and magically reappear on your screen and put the question to our presenter. And if it's not particularly slide sensitive in terms of timing, I can always hold those questions until the end. And lastly, I'll just say that we will be recording the presentation today and posting that to our website in the event that you need to refer back to any of the slide deck at some point in the future. So I guess without further ado, I shall put you in the capable hands of Andre Pouliot, who can get us underway.
All right, and thank you for that, Mark. So look, I thought I'd kick this off with an introduction. It's my goal to try and make this property tax presentation as interesting, as fun as we can. So I thought I would start with an introduction of property tax. We know what property tax is like today. But it's been around for centuries. And what you're seeing is the land and window tax assessments from 1696. At that time, properties were taxed at 2 shillings per house. If your house happened to have 10 to 20 windows, it would cost you an extra 4 shillings. And if you have more than 20 windows, it would cost you 8 shillings. Of course, naturally at the time, more windows meant you were wealthier. And so it was deemed to be a very fair and equitable way of distributing the tax burden. For as long as there has been taxes, there have been people who seek to reduce taxes. And of course, when we had the window tax, one of the best ways to avoid tax was to board your windows up, and that's what you're looking at. I'm certainly not going to recommend that we board up any windows today, but I am going to walk you through what is an often misunderstood assessment and taxation system in New Brunswick and give you some angles to help you understand it better and perhaps help you reduce your own taxes. So look, the agenda as I've got it laid out for you, we are going to talk about a property assessment overview generally. And as I promised in my invites and some of my social media, I'm going to discuss uniformity, which is equity. And there's 2 pieces of that. There's uniformity of assessment, that's how we calculate the values. And of course, there's also equity of taxation, which has to do with our tax rates. I'm going to give you some history on assessment in New Brunswick. And I'm going to present a mystery of the declining number of appeals. Certainly, as frustrations mount in the assessment system in New Brunswick, one would expect appeals to be on the rise, but the opposite is true. And we will explain that mystery. We'll then move into some individual asset class considerations. So I've looked at the names of everybody who's attending, and I will be talking about hotels, apartments, industrial, manufacturing, apartments, seniors care, offices, and retail. So look, for the assessment overview, I'm not going to spend a ton of time on this. Look, it says, the Act says, all property shall be assessed at real and true value. Real and true value is intended to represent market value. And equally important to value is when, since values change all the time. And for 2022, our real and true value is based on the 1st of January of this year. Most of you would have looking at the names again, most of you understand how appraisers work out property values. We look at a cost approach as one option. We use that for owner-occupied commercial, industrial properties. Income is something that we apply to investment properties. So we look at, how much net operating income we expect the property to be able to generate, and then we convert that into a value based on, return expectations by investors. And the final one is a direct comparison approach. And that's really only used in New Brunswick in terms of for single-family homes and in defense of other property assessments. What is mass appraisal? So mass appraisal is basically how Service New Brunswick estimates the assessments for the 400,000 properties that exist in the province of New Brunswick. Their goal, unlike an appraiser who's trying to figure out the value of a single property, their value is to try and generate, estimates of value that are close to the center of the dartboard. They're not all at the center for all of the properties. And this involves developing models for all the different types of properties you can think of. So if properties have different neighborhoods, it needs a different model. If they're a different type, it needs a different model. We need a different model for Class A office than we do for Class B office. We need different models for power centers than we do for retail strip malls. And that's what would normally be done under mass appraisal. The appeal process, I'm really just going to touch on this briefly. I think everybody knows if you're not happy with an assessment, you appeal it. And if you're not happy after you appeal, you get a crack at taking it to a hearing. And that's pretty much the same in every province in Canada and every state in the free world. So equity. The reason why I wanted to focus on this, and I'll give you the preamble on it now, is that I know a lot of owners have appraisals on the corner of their desks. And, I just said it's a market value system. And the appraisal says my office building's worth $15 million. The assessment comes in at $13 million. And I'm sitting there and something in my gut tells me I'm still paying too much tax, but I know that the appraisal that's there says I'm probably not. So that's the purpose of our discussion today on equity. It's a key component of every process. I mean, let's face it, it's a tax. So taxes need to be fairly allocated or we're going to have revolts. So there's two things that need to happen for us to have equity of property taxation. We need to start by calculating uniform assessments, which means accurate assessments. And we need to also have equitable taxation. So what that means is making sure that the tax rates that we applied are fair. And it means that when we do have a differential in rates, we have a really good reason for doing it. Ultimately, if we're talking about municipal taxation, we want to make sure that those rates apply taxes in a way that account for what it costs to service the property. So look, equitable. The window tax didn't work so well after a while. The monstrosity on the left has 2 windows and generated 2 shillings in tax, while the small house on the right had 10 windows and generated 14 shillings. We threw this system out in favor of market value, which we all believe is a better indication of wealth than the number of windows. So in order to understand, we're going to start with uniform assessment, fairness in assessment. And what you need to understand, just a couple of terms. This isn't a stats course, but one of the key terms that I'm going to talk about is assessment to sale price ratio. It's an ASR, real easy. It's the assessment divided by its sale price. Equivalently, it would be an assessment and how it relates to its value. So in the example below, something's assessed at $850. If it's sold or has a market value of $1 million, it has an ASR of 85%. So that's the level for that one property. Now the general level is what would apply to an entire community. I prepared this for a course I guest lecture at Mount St. Vincent University, and I call it Freetown. But as you can see, this is an example of all of the properties that sold in the town, and each one of them has a slightly different ASR. And when we analyze them all and work out the weighted average, we get a general level of 81%. So what does that mean? Well, what it means is I would be fairly assessed on the left. If my market value was $1 million, I would be fairly assessed at $810,000. If you look at the right, I would be unfairly assessed if my market value was $1 million and I was assessed at $950, because I'm at 95% of market value. So everyone else is at 81, I'm at 95, it's too high. It's unfair, and it's not uniform. So that's what we're striving for when we talk about equity and fairness in an assessment system. So I'm going to take you to the mystery. So we're going to talk a little bit more on that. But what I want to do is throw out some interesting stats here, and then we're going to come back and I'm going to give you the answer in a little while. This is from Service New Brunswick's annual report in 2013-2014, and it has a summary of the RFR and appeal stats. So between 2012 and 2014, 1.4% of all accounts in New Brunswick were referred. They were requested, or review was requested. After the request for review, there was 238 appeals on average that went to the board. Those are actually pretty good numbers to start with. Usually it's 1 to 2% of an assessment roll gets appealed in a given year. So now we're going to compare this to the most recent report that Service New Brunswick issued, and it shows that RFR stats in the last 3 years were down to 1%. So we had about a 1/3 reduction in requests for review, and appeals dropped to 145. And so the mystery is why the decline. Why is it that with all we read about in CBC and in all forms of media, with people complaining about property taxes, why are appeals on decline? Does it mean values have improved? Does it mean equity's improved? What's going on here? So that's the mystery. And as I teach you a little bit more, we will get to the answer. So look, a history on equitable assessment in New Brunswick. So I'm going to give you a history lesson. Prior to 1964, every municipality in the province did its own assessments. And the province still levied their provincial education tax on every property. And as you can imagine, all of the towns, they sort of control their assessment, so they can monkey with it. What they did, if you looked at across the province, you would have assessments ranging, say, I believe it was a low of 30% of market value in Sackville, up to something like 90% of market value in Moncton, and everybody else fell somewhere in between. So what it meant was, a municipality, if you have low assessments, you need a higher rate in order to cover your budget. But you benefited, your taxpayer benefited if the assessment was low on the provincial rate, because the province had to collect a certain amount for education, and they levied a uniform rate across all properties, irrespective of how high the assessments were. So a Tim Hortons, for example, in Sackville, that was New Brunswick, that had a market value of 100,000, was probably assessed at 30 grand and paid, I don't know, $450. That same property in Moncton with a $100,000 market value had a $90,000 assessment and paid, closer to $1,500. So between that and individual tax agreements that were made with all the big industrials, the province decided it was time to blow this thing up. And what they did was to centralize all of the assessments into a single entity, which was owned by the province. And their vision was to have uniform assessments across the province at market value. And this is a clip from the Byrne Commission report that kind of flowed into the new Assessment Act. And what I want to throw at you right here is gives you an idea of what they intended. And it's the last sentence, and it says, the owner of property with an assessment ratio, that's what we just saw, ASR, that is higher than the ratio for another owner will bear an unjust and heavier burden. So the Byrne Commission, and of course the government that implemented the Assessment Act after that, didn't want this scenario to exist where one property owner had to pay effectively more tax because their ratio was higher than other property owners. This was their whole reason for bringing the new act and the new system into play. So when they unloaded the system and everything worked, they calculated new assessments. What happens after a while? You administer the assessments for a long time. It takes Service New Brunswick on average 14 years to actually re-inspect a property. So over time, the quality assessments can deteriorate a little bit, especially if you don't have good quality technology. That's a real must now in the assessment process. So, fast forward to 1995, and Rick's Flowers had a greenhouse in Riverview, and their greenhouse was assessed at $40 a square foot, while the other two greenhouses were assessed at $20 a square foot. And, Rick's Flowers quite correctly pointed this out to the appeal board, and the board agreed. They said, you know what, that's not equitable. So we're going to reduce your assessment down to $20 a square foot. Service New Brunswick appealed, and the Court of the Queen's bench was forced to hear it. And they said, you know what, we agree. We've read the act. It doesn't say that anywhere that I can reduce an assessment below real and true value. But in their logic, and this is again a sore spot for me, in their logic, they went back and cited a case from 1964, which was an assessment in 1961, which was before the new act was in place, before Byrne's vision for how this whole process was going to work. And in that case, it's Regina versus the town of Rothsay. And at the time, what they argued was that, hey, you know what, assessments are at 60% of market value in Rothsay, so my house should be as well. And the Court of Appeal in that instance made the same observation, which is, well, the act doesn't say I can assess at a discount to real and true value. So what this decision did, it effectively removed, that equity provision. Almost, I'm going to say it almost removed it, because it's, my job and the job of my colleagues, Chris, who's on the line, and as well as all of those other faces that you saw on the in the waiting room, to secure fair taxation for our clients. So this almost did that. The silver lining I like to remind people of in that case is, I think it's wrong in New Brunswick. I don't think we are carrying forth what was intended by the legislature at the time. I think this decision was probably wrongly decided initially. But given that they're citing this case, I always look at a piece that Justice Savoy did not, who decided Rick's Flowers, that he didn't comment on. And that was that, the judge in the Rothsay case said that, no thought appears to have been given to the fact that the assessment was being made on a principle radically different from that on which the assessed values of 95% of the real estate in town were based. He actually talks about comparing it to the assessment on the property next door, not the value, the assessed value. And I think that is sort of where, our workaround for securing uniformity. And I can talk about that a little bit more, but I'm going to show you something. And this is going to help us get to the bottom of our mystery. So what you're looking at on this slide is what I call the assessment dartboard. And what I want you to think about, that line up the middle that says ASR equals 100%, I want you to think of that as a dartboard. And I want you to look at all the dots. Those are the assessor's attempts to assess every single property at market value. And as you can see, a bunch of them on the left there in the green. If the assessor misses left, he's a little bit below market value. You can see a lot of them are close to the line, and there's fewer as you get lower and lower. All of the properties on the right of the line are the ones that are higher. And actually, this is why the property tax consulting business is a fantastic business to be in, because in theory, every single time a reassessment is done, half of the properties are too high. So there's lots of things that need to be reviewed. Now watch what happens. So it's also possible that these values slip. As I mentioned, Brunswick has a 14-year reassessment cycle. So it's not uncommon for, for ratios to slip a little bit. In any other jurisdiction in Canada, most US states which allow for what we call equalization orders, if the middle assessment was 90% and we have to be treated fairly relative to everybody else, doesn't matter. We still have half of the properties on one side of the line, half of the properties on the other. Everything in red is still a little bit high and can be reduced, and everything green's a little bit too low. Probably not too many owners appealed those to ask for increases. And now I want to show you what Rick's Flowers creates. So the example I'm giving you is my dartboard and the median assessment. So on average, the ratios have slipped a bit, and on average, the assessor's been hitting 85% of market value. But what Rick's Flowers says, it doesn't matter what the average is, I'm still holding you to 100% of market value. And so what that creates is this section of properties in yellow. And all of those properties on that part of the dartboard are assessed unfairly. They are assessed at more than the average for their municipality, yet they're not eligible for reduction under Rick's Flowers, under that decision, because they are still less than market value. And so what you can see is that you've got 6 or 7 red dots there maybe, and they're the only ones that are actually overassessed and eligible for reduction for Rick's Flowers. So we're getting closer to our mystery here. So what I'm showing you now are, again, another excerpt from Service in Brunswick's annual report. These are the levels that they've calculated for residential and commercial property. And it's really the first 2 columns that I'm looking at, and realistically, I'm talking about the residential right now. But you'll see 2012, 2013, and 2014, residential properties were assessed on average 96, 98, 97% of market value. So very close to market value. And you'll recall 1.5% of the roll was appealed, and we had roughly 243 appeals to the board that, in those years. So I can hear, and I wish we were in a room, because if we were in a room, I could see your faces, and I can just see everybody guessing at what the next slide is going to show. The next slide is going to show assessment and sale performance indicators for 2020, and it's going to tell us that something has changed, only it doesn't. Service New Brunswick stopped publishing their level statistics in 2014. So their annual reports from 2015 on haven't had any of these indicators. So it was really a big question mark. And, the question mark, unless you've got a tax agent who wanted to spend a week going over 400,000 lines of assessment in a database. Thankfully, we know of such a guy, and he did that. So what you're looking at on this slide is essentially a ratio study of residential property in Moncton, St. John, and Fredericton. It looks a lot like that dartboard I showed you. So it's a histogram, and what it's showing you is that in 2022, the median ASR for those 3 communities was nowhere near 100%. It's all the way down to 85. And what that means, you're going to recognize this now. So again, let's apply Rick's Flowers principles to this. So we've got a median of 85. We've got the yellow in the section that is who are unfairly assessed, but not eligible for a reduction per Rick's Flowers. And so we only have those few properties at the very end of the tail on the right that are actually eligible for reduction. And so if you're wondering about the answer to our mystery, the answer to our mystery has nothing to do with better quality assessments or anything else. It's simply that it's the ability for owners to secure reductions, certainly under appeal, has simply decreased since 2015. There. All right. So now what I want to do is get into some of the nitty-gritty. I promised I'd talk about all the asset classes. Apartment owners, I also promised I would talk about equity of taxation. And as we get into a couple more slides, I'm going to show you a little bit more about equity of taxation. There's no better place, no better area to demonstrate that with than apartments. There's a lot of apartment owners on the call here today, so let me jump in with apartments. They were reassessed for 2022. They were done in two separate groups. The first group got mailed in October, and it was older, what I've called it the older stock. And it wasn't what you call a reassessment where they calculated new values for every single property. It was what we call a factor. And they just divided them into two groups. One group they decided was underassessed by 15%, and they added 15%. The other group was 20%, and they added 20. It's important to, when you review these assessments, it's important to remember that adding 20% to an apartment assessment, all else being equal, if there's no reduction to the tax rate and we're not able to immediately offset the extra taxes with higher rents, it means the property is dropped in value by about 10%. So, you know, the rule of thumb I'm using is that 50% of your operating costs are property taxes, and adding 20%, you know, adds 10% to your operating costs and impacts your value accordingly. Group B is what Service New Brunswick called new and high-end apartments, and they did what I would call a proper reassessment on these. They ran new models, which which a lot of assessment jurisdictions do every year on every property. New Brunswick really relies, they have an over-reliance on factoring, which I think impacts the quality of some of this stuff. But look, the outcome of that reassessment was that 2/3 of all apartments in that group increased by 20% or more, while 1/3 increased by 50% or more. And we've seen increases over 100%. So we've seen some more than double. I can't give you a rule of thumb because when you double them, the impact on NOI is more than proportionate to the increase in the number of taxes, but the amount of taxes. But let me leave it with you this way. A $10,000 increase in taxes reduces the value of your property by $200,000. And I've seen increases of over $100,000, knocking $2 million off the property. I've seen increases that are even more than that. So these increases are no joke. If there's no corresponding reduction in the rate, and we can talk about that later at the end of the session. I've got some theories on what's going to happen with that. If there's no reduction in the rate and we can't immediately recover the taxes and rents, there are some properties, especially some of these new ones that are highly leveraged, as you tend to be when you first come out of construction, that are going to be in a precarious situation. So, but I ran ASRs on apartments, and I divided them into two groups. Since they were assessed using two different techniques, I put them in two groups. And I'm going to start with the group on the right. That was what we call the factored group, the 20% group. And even though they added 20%, my analysis says that on average, they're about 70% of their pre-reassessment value, which means there's still lots. If you look at the blue lines there in the histogram to the right, there's still lots that are over market value. So they're too high on a market value basis. There's lots, again, that are too high compared to apartments in that group. And we're going to see some other ASRs. There's still lots if you compare to houses. Houses are only 85%. Why do we want, there's still 40% that are more than 85% in that graph on the right. Look at the graph on the left. So these are the new ones. The median's 91%, which means they actually did a pretty good job at getting the value. And I use right in air quotes. But let me ask you this. If you're at 91% on your new buildings and the old buildings are at 70%, and houses are at 85%, and we'll talk about warehouses later, you are being unfairly treated. And even if the median's 91, again, half of them are more than 91% and half of them are less. And I need to remind you of one other thing. I talked in the previous slide about how higher taxes have actually destroyed the value on some of these properties. And what I would suggest to you is that the 70% you're looking at, if we were to adjust all of the pre-pandemic prices by the amount of the value loss, you're looking at a median of over 80%. And that 91, given the massive increases and the amount of value that's been destroyed on those apartments, that median is probably over 100% right now. So if you're in that category, you really need to take an aggressive stance on your assessments this year. So now, we talked equitable assessment. I gave the example of apartments being a great example of how equitable taxation comes into play. So you'll recall the education tax. It was 1.5% applied to all properties in the province. So when the new act came into force, that education tax applied to everything, applied to single family homes. But in 1973, the province decided to exempt principal residences. So, and I've researched it to try to find, actually what the rationale was. There's not a lot out there. I was going to try and pull the Hansard debates to see how the bill was introduced, but it wasn't available online, and I ran out of time. So, but what I can tell you from anecdotally, I had a conversation with a mayor from one of these municipalities at a function I was at recently. And he told me that he was around at the time, and he said it was pitched as a way to improve affordability, to make home ownership more affordable in New Brunswick. So I find it ironic that in all these conversations about affordability around apartments, that the obvious hasn't come up, that we should simply just get rid of this rate. But look, what's happened with that exemption. So with the exemption, apartment properties end up paying roughly double, depends on your municipality, but your overall tax rate is roughly twice that of a single family home. There's two X's there because A, it's unfair relative to other properties in New Brunswick, and B, it's inconsistent with what other jurisdictions do. It's true that other jurisdictions have provincial taxes, or that municipalities gather some tax on top of the municipal tax for provinces, but none of them are the degree that New Brunswick is. I think Nova Scotia charges levies 0.3% or something like that, compared to New Brunswick's 1.29 or something. So below you see that the exemptions created a situation where commercial's paying 3 times the rate of residential, and I show an X there. There's no justification for ever having a business property pay more tax. There's been studies done for years. Kitchen and Slack, who are the preeminent experts in this stuff, have always said that every study that's ever done has shown that businesses actually subsidize homeowners. So that's why it's an X relative to everything in New Brunswick. The green check simply means that everybody treats business owners poorly in Canada. So it's the same everywhere. If you're in Halifax, business owners contribute way more than homeowners. Montreal, Vancouver, it's the same thing. But look, here's a double tax at work. I've seen, and people pick and choose their comparables. I've read some media stuff about this, and I kind of objected to it as soon as I saw the comparison. I'm trying to give you a reasonable one, but I could easily give you 50 properties in Halifax and 50 in New Brunswick, and you'd see the same type of inconsistency. The top picture is the Alexander. It's a fairly new building, downtown Halifax. Market value assessment is at $300,000 per unit. Property taxes come in at $4,000 per unit. This is 241 Reed Street in Moncton. It's a new building. The assessment this year came in at $268,000 a unit, and that generates taxes of roughly $7,600 a unit. It's, you know, almost as much as what I paid in total rent for my first apartment. All right. So next up, I've got hotels, restaurants, and hospitality properties. So what I want to just start with here is give you a background of what happened last year, and then I'm going to circle back to what's been done this year. So last year, hotels were reduced by 25%. If you own a hotel, you're probably grateful for it. But I'm going to tell you a secret. The secret is that we appealed a bunch of hotels last year. We were successful, I would say, on 75% of them. But in our research, what we learned was that Service New Brunswick, through their consultants, had learned that or had determined that hotel assessments had lost 40% of their value as a result of the pandemic. The decision to bring them down 25%, was because, like everything else, they weren't at 100% of their value. In fact, they were only at 85%. So the net reduction was 25. And I had a chuckle when I learned this. I said, okay, you're telling me that everybody was at 85% of value in 2020. For 2021, when we tried to get the hotel assessments right, we left everybody else alone and adjusted the hotel assessments so that they're at 100% of market value, which I find very ironic. You know, when you frame it that way, we weren't really treated that very fairly as hotel owners. So what's happened for 2022? You've probably seen now that your assessment is at 15% below its pre-pandemic assessment. Again, I have to question whether or not we're targeting 100% of market value, which would be very unfair looking at everything else that I've shown you, or if you know, or if it's you know, if they've thought better about that adjustment. So restaurants, on the other hand, they were reduced 15 to 25% in 2021. They have since returned to their pre-pandemic levels for 2022. Again, I'm not so sure that's reasonable. They're not all the same, and hotels are not all the same. So airport hotels, for example, inns, full service hotels with convention centers, they're all different. The Algonquin, you know, is different than the Super 8 in Dieppe. The Amsterdam Inn is different than the Delta in Fredericton. You know, but they've been treated exactly the same for assessment purposes. And I really think that this is something that, as a hotel owner, you really have to dig into. Again, and it's another one of those examples where I know if you've got an appraisal on the corner of your desk, it's probably a lot more than the assessment. But even if that's the case, odds are you're still being treated unfairly. And if your gut tells you you're being treated unfairly, it's something that you should look at. So industrial. Industrial, what we're seeing in 2022 are increases ranging from 8 to 10%. What you need to understand is that, and I think most people do, is that this industrial is being driven by e-commerce. To put it in perspective, e-commerce has grown it grew by as much in 2020, between 2020 and 2021, as it did in the 10 or 15 years before that. It's been an incredible exponential growth, and that's just driven warehouse rents. It's driven return expectations for investors way down on those assets. So that makes perfect sense. What I've seen in New Brunswick on this, now frankly I don't get the 8 to 10%. You know, my data tells me it should be up more. But what I've seen with the assessments in New Brunswick is that a lot of properties that I'd classify as manufacturing, they got nailed with that 8 to 10% factor unfairly. So if you're a fabricator, if you're a cabinet maker, and your building looked more like a warehouse than it did like a like a manufacturing facility, I think what you've seen is a higher increase than what you would have got otherwise. So I would encourage you, if you saw that factor, you really should have a look at it. Ultimately, many of these are in many manufacturers are sort of in the opposite. Some have seen a huge bump because of the pandemic, but others are either restricted in terms of their supply chains and producing things, or they're restricted on the demand side and getting product out. So there'd be cases to be made for a lot of special purpose properties that there ought to be a reduction in assessments this year.
Andre, just interrupt for a quick second. There's a question that popped up during the last slide. Just bear with me for a minute here. When you're talking about restaurants and hotels, it says,
Yeah.
Andre mentioned that not all hotels are the same airport hotel versus a downtown hotel, and as such, they would not be affected in the same way by the pandemic. What about restaurants? Some have drive-throughs, which would have had continued to operate through COVID lockdowns, whereas others are dine-in only. Is there a case to be made that they should have their assessments treated differently?
100%. Again, mass appraisals about trying to group properties and adjust them with broad brushes. But the truth is, a McDonald's with a drive-through is not the same as a family restaurant with seating only. I would also say a lot of the larger restaurants would be affected differently than smaller restaurants. I'd ask myself, what's my ratio of seating capacity to kitchen capacity? Restaurant owners are, they're entrepreneurs, and they're very skilled at adapting. So I would say, if you're an entrepreneur and you own a restaurant, look at your physical premises critically and ask yourself if if it's still, the model or the standard that you'd want to have in a post-pandemic world, or not even in a post-pandemic world, but on January 1st of 2022, because we're still not post-pandemic yet. So that'd be my answer. So I was able to do an ASR analysis on warehouses, and as you can see, when I said they only went up 8 to 10%, realistically, warehouses are at just under 80% of market value. And if you look at the histogram, there are some properties, over 100. But in theory, you're unfairly assessed compared to other warehouses if you're more than 77%. You're unfairly assessed compared to homes if you're more than 85. And again, if I'm picturing apartment owners on this asking the question, all right, the province saw the need to reassess apartments and apply these massive increases. Why apartments? Why not warehouses? Why not single family homes? Why did single family homes stop at like a 10% bump? Why didn't they, in theory, if you remember that graph, if you added 15% to the assessments of those single family homes, you would have an ASR of 100%. So if that's the goal, then why aren't we doing that? And why did we select apartments for reassessment and not these other classes? And I don't have the answer for those, although I have theories. So let me talk retail, office, and industrial. The takeaway on retail, office, and industrial is, I would say retail and office here, because we talked about industrial. What I would suggest to you is that not everything's created equal. So let's start with offices. Ask yourself what Assumption Place, what 275 Main Street in Bathurst, and what 40 King Street, being a 4-story building in St. John, have in common. The truth is they're offices, and the truth is the only thing they have in common is the change in their assessment. They'd all cater to different types of tenants. They're configured differently. They're in different locations, yet their assessments all change by the same amount. If you own an office building, what I'd recommend that you do is consider how work from home impacts the tenant classes that you're catering to. You know, truth be told, I've spoken to landlords. Professional services, doctors, or professional services like lawyers, accountants, management consultants, those types of entities. I think they've all, the cat's out of the barn, or the horse out of the barn on work from home. Most are developing policies now to allow it. They're going to allow some flexibility, but those groups are going the other way. You know, and I think it makes sense. What they're doing is saying, look, employees are demanding this. They're demanding that flexibility, but we want to give them a reason to come to the office. So they're expanding. So if you have those buildings, you might be in pretty good shape. But if you're in, if you've got call centers, some federal government departments, what I would encourage you to do is go and count the cars in the parking lot. Because if you've been counting the cars and there's not very many cars there, and you haven't seen it fluctuate as we've come in and out of the different phases of the pandemic and the different restrictions, I would suggest to you that your renewal probability on those large tenants is a lot lower. And with a lower renewal probability, we're going to see a reduction in value. Investors are going to give you less. The second thing I would suggest you look at, and this isn't just a pandemic thing, this is just about investor appetite for properties. I've got some concerns about Class B and some of the Class C buildings. Ultimately, what I'm seeing is a shift in what purchasers are looking for. ESG is getting to be a huge impact on what investors want in terms of buildings. So we're not just looking at NOI, we're looking at the building's wellness standard. Is it LEED certified? Is it, are there opportunities to enhance it by adding solar? And I think a lot of our Class A buildings, they're going to warrant those types of upgrades. But I think a lot of the types of Class B buildings that don't are going to stagnate in the market. And I think it's going to be a different class of purchaser that would get them. So while they might have formed parts of big investment portfolios in the past, I think they're less likely to today. And if you pull that purchaser out of the pool of purchasers, I think that those values have been affected. So meanwhile, retail's not all created equal as well. Look, percent rents down at regional shopping centers. Open air centers, they were falling out of favor well before the pandemic. Any property that's got vacancy, is going to be struggling. Anything that's got a major tenant that includes a cinema or a restaurant or a trampoline park or play gym, all of those types of tenants, and the reason why I say those is because they tend to occupy pretty big footprints in some of these power centers. I think all of them, again, we talk about renewal probability. We've already seen evidence of cinemas renewing at lower rates in Western Canada. So we talked about restaurants, and the trampoline parks themselves. Those are, those owners are going to need assistance to get through this, even going forward. So those are some of the things that I would suggest to you on the retail side that might have an impact. So
one other question, Andre. It's not property specific.
Okay.
Or tied to a specific type of property. Just a general question. What is the risk of an assessment increasing on an appeal?
So I get asked that once in a while. I've never had it happen. I know it's happened. Like I could probably count them on one hand, with it being other tax consultants or property owners have told me about it. It's generally a rare occurrence. I do find that in some assessment jurisdictions that attitude's changing. I've truly sensed a changing of the guard where assessors have gone from being that civil servant mentality where they're there to serve the public to maybe somebody that's more there to defend the role. I've noticed that trend. So I mean, could it happen? It could. It's very rare though. It's very rare in New Brunswick. And in fact, there's a case in New Brunswick that talks about it, and it it actually scolded Service in Brunswick for even suggesting increases, because the court, as I recall in the ruling, what the court said was the threat of it, the mere threat of increasing assessments, can actually deter people from exercising their appeal rights. And appeal is, something to remember with property assessment. It's the only tax, it's the only assessment that you don't do yourself. Your income tax, you file it, you self-assess. Your HST, you file it, you self-assess. This is the only one where the government comes to you and says, hey, this is what we think you owe. So it's very important that appeal rights be protected and encouraged, and so I think it's unlikely. I can't say it's never going to happen, and I can't say it's never happened, because I know it has in some instances. So.
And I can throw in my 2 cents. I'll cross over from moderator to panelist for just a brief second. I would echo your comments. In the last 22 years, I've seen it maybe 3 or 4 times, and it tends to be for factual errors, not where the assessor comes back and says, well, we had 18% depreciation on it. You know what? I think it should only be 17. That's a subjective call. It's more a client may have appealed something, and during the course of the appeal find out that the assessor missed a 10,000 square foot addition on the building. Well, that's a factual error. It probably should be on the assessment. But even in those cases, in my experience, the assessor is more likely to say, you know what, I picked up on this missing addition. I'm going to put it on next year's assessment, and rather than use it as a way to jack up the current year. That's been my experience anyway.
Yeah, and listen, historically, that's how New Brunswick would handle it as well. But there's been a changing of the guard. A lot of those old school assessors, they've moved on. So, it's as cultures change within organizations, sometimes the behaviors change as well. So it's maybe a wait and see approach. But I agree with you. But I'm slightly less optimistic that it will never happen today than I might have been 2, 3, 5 years ago. So look, institutional assets, senior housings, and schools. Seniors housing, look, vacancy's gone up at a lot of them. We had some successful appeals last year, and we cited the rising vacancy as well as rising operating costs. Some of these, anything with care that provides, nursing and meals and stuff like that, the operating leverage is really high in those things. So it doesn't take much change at the top to see a big reduction at the bottom. And we were successful in the ones that we contested last year. And one of the things, it's sort of like the restaurant comment I made earlier in that question. There are some instances here where we'd be looking at some of these older facilities, and suddenly there's some functional deficiencies there that they were there before the pandemic, but this has put a microscope on it. And these functional deficiencies are probably things that a purchaser would no longer overlook. So, I've got a case right now on one of the large ones in Nova Scotia, and they had shared rooms, for example. And of course, the shared rooms and the ward rooms, those were, that left patients very vulnerable to COVID. And so that has dramatically altered the value of that facility, like substantially. And, it's something that I would say, well, the government overlooked it. They allowed it to happen years, during the pandemic and the years leading up to it. I think it's something that a purchaser might have overlooked, 3 years ago, but certainly today it'd be something that they wouldn't have any tolerance for overlooking anymore, and would penalize the value very tersely. And so that would play into any asset. It would play into restaurants if it's designed in a way that you wouldn't design post-pandemic. It would reduce the value. So look, that's a shot of our entire tax team. We are very broad, and we are keen to hear your assessment issues and help you if we can. And with that, I came in at 55 minutes, which isn't bad. I'm wide open to questions. Either now you can type them to Mark. If not, you can pick up the phone and call me. I love talking property tax. If you really want, I would love to have a long conversation with somebody about what it would take to bust open that uniformity argument. But let me close with one thing, just in case I've misled anybody on, or if I maybe left you feeling defeated about the uniformity thing. Those properties that are in the yellow chart, it's our job to be creative and be persuasive and to try and get those assessments into a little bit closer to that median line so that they bear a fair representation to other properties. And that's in my opinion, where we really earn our value in New Brunswick. So with that, I turn it over to questions.
I've got one general question here. Should you be submitting the income expense questionnaires when SNB sends them through to you? And should you do it every time or certain times?
So look, you don't really have a choice. Service New Brunswick sends them out when you file a request for review. If you don't send it, you're going to get a letter of non-compliance and your review will be over. That being said, you should be judicious about what you send. You should be judicious about what you send in addition to the questions. They will also request it during a reassessment. So for the new and high-end apartment buildings, owners got requests for all of those in the fall. So those, and I did comply for all of our clients that I represented. We complied with those requests. Yeah, so if you don't, you risk losing your right to appeal. Although I can tell you, New Brunswick, if they don't demand it, your appeal rights, demand being you get a registered letter saying send this in 14 days. If you haven't received a demand, your appeal rights aren't at risk. If you did, they are, but they are quite reasonable. They are less likely to use it as a tool to dispose of appeals rather than as a tool to get information. They're a little bit more sincere in New Brunswick than they are in some other jurisdictions. All right. Hearing no questions, I hope you enjoyed our show. I hope you found it informative. And I'm looking forward to having conversations and dialogue with anyone who'd like to reach out to me privately after. Thank you.